In modern markets, expiration week is governed entirely by program trading. If you can't read these algorithmic sequences, you're operating blindly. You are retail liquidity. Standard retail indicators, candlestick patterns, the relative strength index, moving average crossovers, fail completely during what quantitative desks designate as a yellow expiration week. These traditional tools rely on historical price averages. When high-frequency execution algorithms take over the tape, those historical averages lag far behind the sheer speed of institutional volume. The retail participant attempts to trade price action. Institutional programs do not look at price. They execute predetermined sequence states based on time and liquidity thresholds. When a trader applies static support and resistance logic against an algorithmic sweeping motion, their stop losses are triggered instantly. The algorithm sweeps directly through these imaginary boundaries, eroding capital trade after trade. Surviving an expiration week requires abandoning the noise of retail charts. You must learn to map the rigid programmatic sequence hiding beneath the tape. A standard yellow expiration week follows a strict, deterministic dataset driven by options expiration mechanics. This chart maps the programmatic sequence over one expiration week. Chaotic candlestick action is bound entirely by rigid, colored zigzag paths. The top horizontal color bands act as temporal markers, dictating exactly when algorithmic states shift. Mastering these transitions separates algorithmic participants from retail victims. The cycle initiates at the Monday open. This triggers the first algorithmic state, designated as the yellow 11 sequence. The primary function of a yellow 11 program is to map the terrain, establishing initial boundaries. Notice the sharp peaks and deep troughs here. Programs forcefully probe these extremes to map resting liquidity. Beneath these violent, visible price swings, a subtle process of accumulation is occurring. Institutions are building their base positions for the coming days. Retail traders routinely misinterpret these initial probes. They see a rapid spike or drop and mistake it for an early directional momentum breakout. That early Monday momentum inevitably fails. As soon as the price hits the pre-calculated limits of the yellow 11 parameters, the algorithms reverse the flow. On institutional desks, this behavior is called liquidity absorption. The algorithms draw in breakout traders specifically to absorb their orders at the extremes. Monday's yellow 11 effectively builds a structural cage. It dictates the exact parameters that will contain the market for the next 48 hours. By Tuesday, the timeline advances. The sequence executes a handoff from the yellow 11 bounds into a secondary state known as the Bernice algorithm. We confirm Bernice is active by watching for specific volume shifts and tightening volatility, represented by this green segment. It shifts the market into a highly focused directional probing pattern, visible in this tight, downward sloping channel. During a confirmed Bernice phase, the optimal stance for a proprietary trader is defensive. You minimize market exposure and strictly observe the probe. Over-leveraging during Bernice is dangerous because the algorithm is actively hunting for resting stop-loss orders built up from Monday's retail participants. Correctly identifying the Bernice handoff keeps a trader from getting chopped up in midweek noise. You preserve capital while waiting for the true execution setup. As the temporal focus shifts to Wednesday, we encounter the red 11 pattern. This is the final positioning phase of the early week. The red 11 is a programmatic reset mechanism designed to lock in profits and realign institutional order books. Notice the aggressive, steep downward trajectory. Algorithms execute this heavy realignment rapidly, dropping the price without collapsing the broader weekly structure.
This creates a classic trap. Retail traders universally look at this sudden drop and assume a macroeconomic trend reversal is underway. However, analyzing the microstructure deviations, specifically anomalies in VWAP and volume profiles, proves this is a calculated programmatic reset, not genuine panic selling. The red 11 phase completes its objective when specific order flow triggers hit the tape, marked by a sudden halt in the aggressive selling pressure. At the very bottom of this curve, institutions rapidly step in. They absorb all the panic selling liquidity generated by retail participants who shorted the drop. Surviving the illusion of the red 11 drop without capital erosion is the mandatory prerequisite. You must preserve your position to trade Thursday's high-stakes setup. Thursday morning acts as the fulcrum of expiration week. All the early positioning from Monday through Wednesday culminates right here into a highly pressurized setup. The initial logic controlling the market on Thursday morning is defined as the blue 11 state. The parameters of the blue 11 state are inherently unstable. The order flow here can drastically alter the market's direction. Thursday morning is a waiting game. Traders watch the tape to confirm if the blue 11 structure will hold its trajectory or snap. The core pivot event of the entire week occurs when the unstable blue 11 state executes a technical flip into a locked blue 2 state. We mathematically confirm this flip has occurred by tracking exact microstructure shifts, a sudden change in bid and ask density paired with waves of aggressive programmatic buying. The moment the blue 2 transition is confirmed, the risks for any participant caught on the wrong side of the tape are immense. The algorithm will not offer a chance to exit gracefully. A failed blue 11 immediately reverts the market back into heavy chop, but a confirmed blue 2 forces an aggressive structural breakout. Once locked, the blue 2 state recalculates the board. It restructures the entire liquidity profile for the remainder of the week. Identifying and confirming the blue 2 flip on Thursday is the single mathematical requirement to predicting and surviving Friday's high variance close. That brings the sequence to Friday. The final 24 hours of expiration operate purely as a day of high variance binary resolution. Thursday's locked blue 2 logic mathematically forces Friday's price action into a 50-50 probabilistic coin flip. The mechanics of this split are not random. The direction is dictated entirely by the net aggregate order flow accumulated by institutions from Monday through Thursday. This setup injects extreme intraday volatility into the tape. Competing algorithms aggressively resolve expiring options positions, battling for control of the final strike prices. Attempting to scalp this specific environment using retail logic is mathematically disastrous. The stop-loss runs are too wide and reversals too sharp. Stepping into Friday's volatility without the comprehensive mapped context of the week's sequence is trading suicide. As the clock runs out, algorithms attempt to pin two ultimate targets: returning to the original yellow 11 bounds or initiating a new yellow 3 state. Landing exactly on a yellow 11 point signals the programmatic cycle completed perfectly. The alternate resolution is a volatile snap into a yellow 3 state. This indicates an overflow of institutional directional positioning, signaling high momentum for the following week. This is the proprietary trader's edge. Despite Friday's intraday chaos, the algorithms relentlessly pull the closing price toward these exact pre-calculated yellow nodes. To survive expiration week, discard the retail indicators. Trade the rigid programmatic sequence and map the algorithm.